everybody. Thanks for joining us today. It's my first episode of Aminas Mortgage Services YouTube channel. And I thought I'd start out by providing parents with an option for something that we all must, take care of, our children. Some of you may have children, grandchildren. Some of you may be aunts and uncles and thinking about your nephews and nieces. And so I thought we'd start out by talking to Michael Lampel of Insurance for Children. Thanks for joining me today.
Thank you.
So, Michael, can you just give us a basic overview of who you are and what Life Insurance for Children is, and how you came to have this company?
That's an excellent question. I have three kids. I've got a 23-year-old daughter, I've got a 21-year-old son, and now I have a 6-year-old daughter.
Wow.
And when my daughter was born, I had to make a very important choice at that stage of her life, which was, how do I now set something up for the rest of her life? Because I was 48 when I had her.
Mm-hmm.
And I went home and I said, to my wife, we have to choose between the registered education savings plan or something else. But ultimately, I had to think much bigger than just the first degree.
Exactly, yeah.
So I said to her, I'm going to open for her a participating whole life insurance plan. And my wife said, what is it? And I said, basically, the way it works is if Elizabeth qualifies, she's going to earn a tax-free annual dividend the rest of her life, starting today.
You said tax-free?
It is tax-free.
Okay.
All the growth in the contract is tax-free.
Okay.
And she is free to use that money towards any education program in the world she wants. It continues to grow. She can use it to build her first home. She can use it to open her first company. And it's got built-in...
Invest in real estate, anything she
Invest
wants
in
to do.
anything
Go to
else.
school or not
Go
go
to
to school. Okay.
On top of that, it also comes with built-in permanent life insurance, which means that when she is an adult, she'll never have to purchase life insurance ever again.
So this is
and it'll protect her future family.
Okay, so this is in essence a life insurance plan for life.
It's
Like
a life
she never
insurance.
has to go through the hassle of having a health questionnaire done again or qualifying again.
Mm-hmm.
Once we qualify her at 6 or whatever, she's qualified.
Once it's placed, it's permanent for the rest of her life. So no matter what health issues arise in her life, no one can ever take this plan away from her. So it'll protect her future family.
And are the premiums set and always the same, or do they rise over time?
The premiums are guaranteed for 20 years, and after 20 years, that was the greatest part. After 20 years, this contract is permanently paid. Not one more dollar will ever be required from the parents or her ever again. And the dividends, which she's paid every year, will continue to grow the rest of her life.
So does it work like the dividends reinvest themselves, so it grows?
Yes.
And is there also,
works
so
very
there's
much
a
like
life, okay, so there's a life insurance component, but then also an investment component?
Yes,
Okay, so it's two separate things.
two separate things.
And one is a cash component and one is the life insurance until it
That's
cashes
right.
out. Wow.
So a very typical example, our average family does about $200 a month, $208 a month. And when we have a lot of families do it from the moment the child is like 15 days old, because that's the earliest they can apply. They pay to the age of 20. At that point, the child has $76,000 of cash to go to university with $600,000 of fully paid up permanent life insurance. They can tap the money to go to university, or they can just let it grow. 35, they want to buy their first home.
Mm-hmm.
There's $200,000 in cash value they can access for the down payment with $1.1 million of fully paid up life insurance. And it will continue to grow throughout her life. So if my daughter is smart and she manages the contract well,
Mm-hmm.
when she's 65, there's over $1 million of cash for her to retire on. And there's over $2.5 million of life insurance for her future family. But she can access the cash value for anything she wants.
Okay, so until we were faced with, unfortunately, the decision that we could not put like a RESP in plan for our daughter because unfortunately she has certain issues that may prohibit her from going to school later, we then were introduced to life insurance. That's how we met.
Yes, the
So
participating whole life plan.
there's many parents, most parents only know about the RESP.
Yes.
What's the difference between the RESP and this life insurance, the permanent life insurance?
The RESP, the Registered Education Savings Plan, is a government program with government rules on where your child can go to university and what program they can study.
So you can't, as a parent or as a child, choose, I'm going to go to X university and study X degree because that's my goal.
That's choice. The challenge, that's a good point. I mean, when you're looking at the future generations,
Mm-hmm.
your daughter, my daughter, education now is a global affair.
Mm-hmm.
they need the flexibility to be able to go wherever they're going to need to go 15 or 16 years from
Right,
now.
things are changing
So when parents are
constantly.
now putting money into a government program, they are not aware that there's government rules attached to this government program. And the government rule number one is, first off, it'll only pay for the first degree.
Okay.
Secondly, considering that kids today are going to need multiple degrees in order to keep advancing their career, the other part is, what if they need to go to university that's somewhere in the world that right now doesn't yet exist, that the program doesn't yet exist? So the choices they're making now is to put their money into a government program that 15 or 16 years from now may not be able to qualify the program that your child 16 years from now is going to want to go do.
Wow. And is there a taxation issue as well?
There's taxation. The only, the tax benefit really is that the growth in the money inside the government program is tax deferred, not tax free.
Okay.
It's tax deferred. Because eventually there will be taxes. The other tax implication is, what happens if the child doesn't go to school?
Right.
What happens if they go to a program that's not approved? What happens if they choose to skip university for 5 or 7 years? There's a timeline also that these plans have to be shut down 35 years from when they're open. So they're not indefinite. Parents can't just keep them as an open account for the rest of their lives. So once that happens, now the tax complications begin. The first part is, all the grants you receive have to go back.
Everything.
Everything, even if you lost it in the stock market.
Oh, okay. So there's no forgiveness.
There's no forgiveness.
Okay.
So if you're investing, if you want growth in the government program, then you've got to put it into the market. And if you do happen to suffer setbacks, the government says, we gave you the money, you got to give it back.
Too bad.
The second part is, it's not unlimited. The maximum amount parents are going to get is $7,200 if they put in $36,000.
Right.
That's all they're going to get.
Right.
For a university degree, that's going to cost over $120,000 15 years from now.
So let's take that same $35,000.
Yes.
We put that into the RSP. We've gotten $7,200 from the government. Right. Let's take that and
put it in the
child
plan.
Yeah.
In the child plan.
Yeah.
First off, there's a guaranteed minimum cash value. So the contracts come both with the guaranteed cash value and dividends. Now the dividends are vested automatically and they're given out tax-free. They're deposited tax-free into the contract every year. They're not subject to the stock market.
So there's no capital gains to worry about.
None of that.
Nothing.
And it's vested, which means that every year you get the statement, the dividend has been deposited into the plan by the insurance company. Whatever happens in the markets has no bearing on that contract.
Now here's a question though, because insurance companies are getting acquired by other bigger insurance companies. What happens to the plan in that instance? So you say, I've started the plan, I'm with X company, they're a big
Our
company.
child plan.
You think that it's going to be around forever.
Yes.
And then all of a sudden, tomorrow it's gone. What happens to the plan? And what happens to all the money that you've invested?
If the insurance company is acquired, your contract is sacred. It continues to run the way you set it up from day one.
Okay.
They are never allowed to make any changes to that contract. Whoever is acquiring the insurance company that sold the plan, which these companies, by the way, have been around since 1875.
This company specifically?
This particular one that we work with has been around since 1935.
Wow.
They have not missed a dividend payment since 1936 when they began. The other three companies we deal with have been around since 1872 and 1875, have not missed a dividend payment. If they're acquired, it's law. You cannot touch the contracts.
Okay.
So the contracts are vested for life until your child's last day on earth. But the dividends will continue to be acquired.
Okay.
So they cannot touch the structure of the contract.
Now, the other thing that comes to mind is children don't have the responsibility to manage a life insurance
That's
plan, right? So until they're 18,
Yes.
who owns the life insurance plan and who's the beneficiaries and how does that all work?
These are investment contracts with life insurance. That's the way we educate our families. The most important part is the contract is actually owned by the parents. And not until the child's 18, until the parent decides they're ready to give it.
Oh, okay.
So if the child is 30, 35, it's similar to a parent buying a house for a child.
Right.
Their name is on the deed. The value of that house continues to grow. The parent is under no obligation, even though they bought it for the child, they're under no obligation to give it to the child until such day they're ready to give it.
Okay.
So if the parent says, I'm going to hold on to this house till you're 45 years old, it's their property. They can hold on to the contract until they're 45 years old. And here's the best part. When the parent is ready to give it, the transfer is 100% tax-free.
Oh, really? So the parents
there
don't
could be
incur anything and neither do the children?
None of the child. So if there's $300,000, $400,000 of cash in the contract, There's no taxes for the parent to just hand it over as a gift. It's the only tax-free gift in Canada.
Oh, that's pretty huge,
That is
especially when you
huge.
want to
Right.
give like a monetary gift of down payment or education or
Correct.
yeah, and pass it on.
Pass it on.
And now, if that child, in certain families, things happen and the children are not around anymore, do they then get to pass it on to their children or to another parent, or do the parents just hold on to it until they expire?
Well, the child is the insured person of the contract. So if the parent says, I'm just going to hold on to it until I think you're ready, the child then has children. And I've had situations. If the child has children, the parents who own the contract can actually skip their child and give that contract tax-free to their grandchildren and say, here you go. There's the gift that we set up. But it's a lot of flexibility, so it leaves a lot of room for the parents and the children to make decisions together on this contract, on what will happen.
Okay.
So they're not locked into a government program that says you must follow the rules.
Right.
An RESP is only for that child and that's it. First degree only to an approved education. This is equivalent to a parent saying, I'm going to buy an investment property and we're going to run it together, we're going to manage it together, we're going to look at it together, and we're going to decide what the future of that investment is for us.
Sounds good. What are the steps to qualify?
Well, the first thing is when parents are doing it, that's the greatest advantage is the reason parents do it when they're young is because the children don't have any health issues when they're younger. So the greatest advantage is, number one, the cost is way cheaper. Number two, by the time the child is in their early 20s, it's completely paid off for life. And number three, the health issues aren't there yet.
Right.
So the children are not yet smoking at the age of 4 or 5. And as we say, we have families who do plans on children as early as 15 days old. We have families who do plans on children as late as 25, 26 years old. The advantage of doing it earlier, especially with these contracts, is they are life insurance contracts, so health is an issue.
Right.
So when you're talking about children, the children yet don't have those health issues. So the insurance company is able to be a lot more flexible when they're a child. So they can contact us at insuranceforchildren.ca and ask us questions, and we always like to give feedback.
Now, in certain instances, children do have issues.
Yes.
Cancer, what have you, mental health issues, for instance. What happens in those instances? Is it an automatic denial, or do you take it case by case?
The way we do our business, the way we service families, the way we help families is we don't just simply go and put in applications. We sit with the family, we ask the questions, we then speak to the companies and see what can be done before we put the families through it. We want to make sure the families have all the information they need in order to make an informed decision. And most of the time, because of their age, the insurance companies are going to be really forgiving. And that's the advantage of doing it younger. Even if the children have health issues, because of their age, there's going to be a lot of feedback from the insurance company.
Okay.
And we don't just simply put it in and say, let's just see what happens. We want to be able to give them the feedback. And that's the advantage even when the child is 5 or 6 or 7. Even if they have health issues, it's the best time to do it because then at least they have information what they need to do.
Exactly.
But most kids don't have health issues. It's easy to get it done.
Right. Okay. So it's case by case.
Yes.
And you're open to anybody contacting you for more information.
Absolutely. Insuranceforchildren.ca. They can phone us and speak to me personally. Our plan is Child Plan, which is becoming very well known. Families, and the most common question we get from families is, "Why haven't I been shown this?"
Right.
And I tell them when the RESPs were brought out in 1998, the grants, people just stopped telling families they existed. Even though I have families who've had these contracts for 60, 70 years and they're still running.
Wow. And people just don't know it because you don't know what you don't know. You
don't know until somebody comes around and says, "Did you know this existed?" And we have a lot of fun.
And that's why I wanted to bring this because I
Yes.
deal with a lot of people who have, extra money. They don't know where to put it, and they're looking for something for their children. RSP is not always the answer, and so this might provide something else. Thank you very much for coming
Thank you.
today.
I really enjoyed it.
Yes, thank you very much. So if you want any more information, please contact Michael Lampel and your insurance.
Insuranceforchildren.ca, or you can phone us at 416-642-4346. We'd be happy to answer all your questions.
Thank you. Tune in next time.